Welcome to This Explainer. Today, we're jumping right into some really fascinating bonus material from the 99% perspective. Specifically, we're unpacking Article 3, which is called The Investor Side of the Housing Trap. We're going to take an objective look at this incredibly complex and, let's be honest, often pretty frustrating tension between housing as a basic fundamental human need and housing as a superpowered financial vehicle.
So, we are diving right into a core economic conflict that really defines the modern American landscape. Fundamentally, a home is meant to provide shelter, it's stability, it's the foundation for a community. But simultaneously, in our economy, it's also treated as this primary wealth building asset, right? It's literally one of the main ways regular everyday people are told they can achieve financial independence. And right now, these two identities, shelter and asset, well, they're basically on a massive collision course. Just take a look at the stark contrast in motivations here. You've got an everyday family whose main goals are living, finding stability, and putting down roots. But then, looking at that exact same property, you have an investor who is prioritizing profit, returns, and portfolio growth. When both are competing for the exact same limited supply of homes, the market is suddenly stretched to serve two completely different goals at exactly the same time.
Section 1, Why Investors Buy Homes. Now, it's absolutely crucial to understand the very real pressures driving people toward real estate in the first place. As the source material points out, for a lot of everyday people, investing in real estate isn't just about greed, it's actually a survival strategy. Think about it. With wage instability, disappearing pensions, and the frankly wild rising cost of living, people are just looking for a way to build some solid ground. So they turn to housing for rental income, long-term appreciation, and inflation protection, really just trying to secure their retirement and maybe leave a legacy.
But the scale of this demand is just staggering. According to Redfin, investors purchased roughly 1 out of every 6 U.S. homes sold in the second quarter of 2024. Let me put that into perspective for a second. That translates to about $43 billion worth of homes bought up in just a few months. When that much capital floods into a market that already has limited supply, the whole landscape fundamentally changes.
Section 2, Small versus Large Investors. Now, we can't lump everyone together here. A local individual doing some house hacking on a duplex, living in one unit and renting out the other just to afford the mortgage, has a totally different footprint than a massive institutional investor. We're talking about players like private equity firms or real estate investment trusts. They operate with massive capital, they strike with fast cash, and they literally buy in bulk across multiple markets. Scale completely changes how an investor impacts local pricing and community connection.
Section 3, Impact on buyers and renters.
So what does this actually mean for homebuyers? Well, Redfin reports that investors are sweeping up 1 in 4 low-priced starter homes. That is 25% of the most affordable housing stock. For first-time homebuyers, this creates some fierce competition. They're going head-to-head with investors who can drop all cash offers, close super quickly, and just waive inspections altogether. Because of this, the National Association of Realtors notes the median age of a first-time buyer has been pushed to a historic high of 38 years old. Crazy, right?
And for renters, the squeeze is honestly even tighter. Data from Harvard's Joint Center for Housing Studies shows a record 22.4 million renter households are now what's called cost-burdened. That means they're spending over 30% of their income just to stay housed. And it's not just about higher rents and extra fees. Corporate-owned rentals often mean less flexibility for the tenant and dealing with centralized, distant management instead of a local landlord. Section 4, Neighborhoods and Wealth Gaps.
Now, to be fair, investor capital can definitely successfully rehabilitate neglected properties and bring them back to life. But the broader shift from a neighborhood of owners to a neighborhood of renters totally alters the long-term wealth trajectory of that area. Think about it. Homeowners lock in their costs and build generational equity. Renters, on the other hand, are paying the mortgage, the taxes, and the profit margin for the investor, while gaining zero equity themselves. Over time, this permanently widens the wealth gap.
Section 5, The Policy Connection.
We have to remember that investor activity is shaped by our policy choices. Just limiting investors isn't going to magically fix the housing shortage. To create real solutions, we've got to pull all the available levers. That means exploring things like better ownership transparency, giving more support to first-time buyers, maybe limiting those corporate bulk purchases, and definitely strengthening tenant protections. And crucially, it means fixing zoning laws to aggressively build more housing supply. Because let's face it, scarcity is exactly what makes housing such a lucrative investment in the very first place. Section 6. Towards ethical real estate. So to ensure housing actually works for the 99%, we really need to start asking some critical questions about the homes in our own communities. First up is transparency. Who actually owns the property? Is it a local family just trying to build some modest long-term stability in their own town? Or is it a distant corporate entity focused solely on shareholder returns? Because generally speaking, local ownership reinvests in the community, while corporate ownership tends to extract wealth right out of it. We also have to look really closely at financial accountability. Are these rent increases and extra fees genuinely necessary to cover rising operational costs? Or are they just being pushed to the absolute maximum simply because a super tight market allows it? Ethical investing is about charging a fair rent, not necessarily the maximum possible rent. Ultimately, I think the most important question we have to ask ourselves is this: can we redefine real estate investing? Can we utilize housing to build security for ourselves and our families in a way that actually separates wealth building from community extraction? The goal shouldn't just be to copy the extractive behavior of these massive corporations, right? It should be to build an ownership model that creates real stability for everyone. At the end of the day, investors are really just one part of a much larger, highly complex housing system. But when homes become assets first and shelter second, working families are inevitably going to struggle to compete. To truly understand this dynamic, we have to follow the ownership, we have to follow the money, and we have to follow the impact. So I'll leave you with this to chew on. If the current market requires us to profit from someone else's instability just to secure our own, is the system itself fundamentally broken? Or can we build a new way forward?